Hi, good evening. I'm very sorry. Today, continuous classes are there. Today morning, I took CA final model test paper. Then I had CA and CMA inter classes. Finally, I'm here. Sorry for the delay, but schedules were like that. I couldn't be on time. Anyhow, today we will discuss. Good evening, please welcome. Today, I will discuss with you CA inter model test papers for September 2025 examination. Okay. So after we discuss model test papers, you will come to know how typically ICAE is asking questions. You can see the questions. It is framing questions from nook and corners of the concept. You can see whatever MCQs and whatever questions are there. After reading, you will fumble. You will think, okay, is this question is from this concept? In that way, ICAE is framing all the questions. So you have to be very careful. Before going to examination, if you do these model test papers and mock test papers, you will get confidence. Okay. So that is why instead of attempting straight away in the examination, if you prepare all this, you will get accustomed to the level of difficulty that ICAE is asking the question. So automatically, even in examination also, you will feel comfortable. Otherwise, if you directly attempt examination questions, you will feel them as so difficult. Okay. Now, first we will start discussing model test paper 1. Case scenario. Mr. Kamal, aged 45 years, commenced operations of business of a new 3-star hotel. See, 3-star hotel is eligible for deduction under section 35 AD, right? So, he started 3-star hotel on 1st April 2024. He incurred capital expenditure of 50 lakhs on land. Tell me, capital expenditure on land, is it eligible for deduction under section 35 AD? No, it is not eligible for deduction under section 35 AD. Next. Exclusively for the above business and capitalized the same in his books of accounts as on 1st April 2024. Further, during previous year 24-25, he incurred capital expenditure of 2 crores, out of which 50 lakhs was for land. See, whatever the expenditure on land is there, it is not a depreciable asset, so not eligible for deduction under section 35 AD. Balance 1.5 crores was for acquisition of building. See, this 1.5 crores is for acquisition of building, that is eligible for deduction under section 35 AD. Okay. Exclusively for above business, the payments in respect of above expenditure was made by account payee check. The profit from business of running in hotel was 85 lakhs before claiming deduction under section 35 AD. See how much is net profit? Net profit is 85 lakhs. Now we will reduce deduction under section 35 AD. Tell me how much is deduction under section 35 AD? Whether land expenditure is eligible for deduction? No. Building expenditure is only eligible for deduction. How much is expenditure on building? 1.5 crore, 150 lakhs. So after you claim deduction under section 35 AD, is there profit or is there loss? There is loss. Loss from specified business. How much is loss from specified business? 85 minus 150. 65 lakhs is correct. He has employed 220 new employees during 24-25, details of which are as follows. Do you remember deduction under section 80JJAA for additional employees? Whatever the cost that is paid, 30% of additional employee cost is eligible for deduction under section 80JJAA. Now, there are some conditions like whoever the additional employees are there, they should participate in recognized provident fund. They should work for more than 240 days in a previous year, and their salary should be up to 25,000. So whenever these conditions are satisfied, then only for those additional employees, whatever the emoluments paid, out of those emoluments, 30% of emoluments will be allowed as deduction under section 35AD. Okay, now 40 employees were recruited on 40 employees were recruited on 1st June 2024 on a regular basis. Regular means what? They participate in recognized provident fund. Their salary is 24,000, which is less than 35,000 na. So they are eligible for deduction under section 80JJAA. Okay, next. 80 employees they were recruited on 1st July 2024. 1st July 2024 means they worked for more than 240 days. They are also eligible additional employees. Regular employees means what? They participate in recognized provident fund. They are eligible additional employees, and salary is also less than 25,000. For them, whatever the salary paid, you can claim deduction under 80JJAA. Next. Casual employees. Casual employees do not participate in recognized provident fund, so they are not eligible for deduction under section 80JJAA. Next, 30 employees, they were recruited on 1st September 2024. They worked for less than 240 days. As they worked for less than 240 days, they are not eligible for deduction under section 80JJAA. Similarly, these people also worked for less than 240 days. In current year, whatever the salary paid to them, that is not eligible for deduction under section 80JJAA. But if they continue to work in next year also, for next year to those employees, whatever the salary that is paid, that salary you can claim as deduction under section 80JJAA. Okay. Now, so can we calculate deduction under section 80JJAA? 40 employees. When they joined 1st June, that means they worked for 10 months. 40 employees into 10 months into 24,000 plus 80 employees. How many months they worked? 1st July onwards means they worked for 9 months. 80 employees into 9 months into 24,500. So how much is total salary paid to them? 40 into 10 months into 24,000. 80 into 9 months into 24,500. Total 2 crore 72 lakh 40,000. Next, deduction under section 80JJAA. How much is deduction under section 80JJAA? 30%. So 81 lakh 72. Students, if you want these materials, I will share with you right now in Telegram. You can download. Give me 1 second. Yeah. So I have shared in our Telegram group. If you want the same PDF, you can download from ICAI. In ICAI, all subjects are combined and one model test paper book is given. Now I separated for income tax and I have shared with you in your in our Telegram group. You can download the same as. Mr. Kamal also has another existing business of running a 4-star hotel in Ahmedabad, which has commenced operations 20 years back. So, two hotels. Hotel 1, 20 years back. Hotel 2, recently. See, Hotel 1 is treated as specified business. Hotel 2 is also treated as specified business. But as Hotel 1 is started 20 years ago, Hotel 1 is not eligible for deduction under section 35AD. Hotel 2 is eligible for deduction under section 35AD. Still, as both are specified businesses, loss from one business can be set off against profit from another business. So how much is profit from another hotel? Profit from another hotel is 140 lakhs. After you do set off, still how much is profit? 75 lakhs is correct. Assuming that Mr. Kamal has fulfilled all conditions specified under section under 35 AD and has not claimed any deduction under chapter 6A under the heading deductions in respect of certain incomes, what would be quantum of deduction under section 35 AD? How much deduction he can claim under 35 AD? 150 lakhs na. So deduction under section 35 AD is 150 lakhs. What would be income chargeable under PGBP for assessment year 25-26 in the hands of Kamal? Income chargeable under PGBP will be 75 lakhs. Next. Would Kamal eligible for deduction under section 80JJAA? Here is the twist. Generally, when you claim deduction under section 35 AD, again you cannot claim deduction under section 80JJAA. So whatever deduction under section 80JJAA is there na, this deduction is not available as SSE is claiming deduction under section 35 AD. Are you able to understand? So if SSE is claiming deduction under section 35 AD, deduction under section 80JJAA is not available. So here the answer is A. As SSE is already claiming deduction under section 35 AD, again chapter 6A deductions, certain incomes which are allowable as deduction under chapter 6A, those are not available. So simple thing, whenever SSE claims deduction under section 35 AD, again deduction under section 80JJAA is not available. Okay. Just give me 1 second. Shall we see second one, second case scenario? Mr. Arvind, an Indian citizen, wants to file return of income for the previous year 24-25. He required assistance for which he approached you. He has shared following details relevant to previous year 24-25. Arvind owned a house property in Bangalore and same was rented out for 65,000 per month to Mr. Arjun, a salaried employee. He claims that this was the only income which he earned during previous year 24-25. However, when you had sought for his bank statement, you observed following information additionally. There is a credit of 23,975 towards income tax refund, which includes 5,775 towards interest on income tax refund. So this is taxable under income from other sources. On 15th August 2024, the bank statement showed a credit of 55,000 which he claimed to have received as a gift from his grandchildren. See, grandchildren are covered under definition of relative. Na? From grandchildren, if any gift is received, it is not taxable. That gift is exempt. On further assessment, you are able to understand that Mr. Arvind and his wife had traveled to Mauritius during 24-25. So they went outside India. What will we do? We will calculate number of days of stay in India. Based on that, we will determine residential status of Arvind. Okay. On scrutiny of their passport and relevant documents, you conclude that they left India on 27th September 24 and returned on 31st March. See, the day on which they left India and the day on which they come to India, both days will be considered as stayed in India only. That means what? Till 1st April to 27th September, they stayed in India. And also on 31st March, they stayed in India. So shall we calculate number of days? 1st April to 27th September. How many days? April 30, May 31, June 30, July 31, August 31, September 27. So 180 days plus 31st March 1 day. Total 181 days they stayed in India. See how ICA is asking. Exactly, if they stay for 182 days, they becomes resident in India. They will satisfy basic condition 1. But they stayed in India for 181 days, which is less than 182 days. So basic condition 1 is not satisfied. Okay. During 4 years preceding previous year, both had stayed in India for 320 days. We can take one assumption. We can check basic condition 2. As per basic condition 2, two subconditions. They stayed in India for 181 days greater than 60 days. Subcondition 1 satisfied. Subcondition 2, they stayed in India for how many days? They stayed in India for 320 days, which is less than 365 days. Subcondition 2 not satisfied. So basic condition 2 is not satisfied. As basic condition 1 is not satisfied and basic condition 2 is also not satisfied, they becomes non-resident. Okay. So residential status of Arvind is non-resident. Is there any requirement to deduct tax at source under section 194 IB? See, under section 194 IB, TDS will be deducted only if payee is resident in India. Here, rent is paid to Arvind. Whether Arvind is resident? No, Arvind is non-resident. So, TDS is not required to be deducted. Are you able to understand? So, no, there is no requirement. D is the answer. TDS is not required to be deducted as Arvind is non-resident. Are you able to understand? Which of the following statements is correct with respect to advance tax liability of Mr. Arvind for previous year 24-25? Advance tax liability. See, even though he is non-resident, he is required to pay advance tax in India if tax liability is more than 10,000 rupees. Now, he is getting 65,000 per month rental income. That means 65,000 into 12 months. How much? 7,80,000. 2,34,000 is standard deduction at the rate of 30%. Balance is how much? 5,46,000. He is paying taxes. Let us assume he is paying taxes under optional tax rates. Under optional tax rates, 5,46,000 means tax liability how much? 21,700, which is greater than 10,000. Okay. So, as tax liability is more than 10,000 rupees, he is required to pay advance tax. The third answer is D. Let us check the answer. Third answer is C. Wait. No. In second one, we need to check third. In second one, third answer is D. What we did is correct. Okay. Answer is D only. Perfect. Shall we do question number 3 and question number 4? Now, Roshni Limited has 2 units, 1 unit at special economic zone and other unit at domestic tariff area. So there is Roshni Limited. It has one unit in special economic zone, another unit in domestic tariff area. The unit in SEZ was set up and started manufacturing from 12th May 2015. That means previous year 24-25 is 10th year, correct? 24-25 is 10th year. As it is 10th year, 50% of export profits are eligible for deduction under section 10AA. Okay. The unit in SEZ was set up, and unit in domestic tariff area started from 15 June 2018. Total turnover of Roshni Limited and unit in DTA is 12.5 crores, 4.5 crores. So how much is total turnover? Sales. Total turnover is 12.5 crores. Domestic tariff area turnover is 4.5 crores. Turnover of SEZ is 8 crores. Export sales of unit in SEZ and DTA is 3.5 crores and 2.25 crores respectively. So how much are export sales? Out of sales, exports are 3.5 and 2.25 crores. So total it will be 5.75 crores. And net profit of unit SEZ and DTAA is 95 lakhs and 80 lakhs respectively. So how much is net profit? 95 lakhs, 80 lakhs. Out of export sales of 3 crore 50 lakhs, only 2 crores have been received in convertible foreign exchange by 30th September 2025. See, 3.5 crores exports are done now. Out of 3.5 crores, only 2 crores received before 30th September 2025. Are you able to understand? So, while calculating export profits, while calculating export profits, we will take export turnover only 2 crores. We will not take 3.5 crores. Are you able to understand? So, shall we calculate export profits? Export profits is equal to net profit into export turnover divided by total turnover. How much is net profit? 95 lakhs. How much is export turnover? See, 3.5 crores exports done. But how much is realized in Indian currency? Only 2 crores na before 30th September. So only 2 crores will be considered. How much is total turnover? Total turnover of SEZ is 8 crores. So 2 crores by 8 crores. How much? 23 lakh 75,000. Now how much is eligible for deduction under section 10AA? Deduction under section 10AA is equal to 50% of export profits. 23 lakh 75,000 into 50%. How much? 11 lakh 87,500. So that is the deduction available under section 10AA. Shall we do fourth one? Today is very hectic day. What would be tax liability of Miss Savita, a resident who attained the age of 60 years on 1st April 2025 on total income of 7,25,000 comprising salary income and interest on fixed deposit under default tax regime? So how much is total income? 7,25,000. Under default tax regime, up to 3 lakhs there is no tax na. tax amount is nil. Greater than 3 lakhs up to 7 lakh, tax rate is 5%. 4 lakh into 5%, tax amount is 20,000. Above 7 lakh up to 10 lakh, tax rate is 10%. 7 lakh 25,000 minus 7 lakh into 10%. How much? 2,500. How much is tax? Tax is 22,500. Here, total income is more than 7 lakhs. Na? As total income is more than 7 lakhs, rebate is available. If total income is up to 7 lakhs, rebate is equal to tax or 25,000, whichever is lower. Here total income is more than 7 lakhs. Now, still rebate is available. That rebate will be calculated in 3 steps. Less rebate under section 87A. Step 1, tax on total income. How much is tax on total income? 22,500. Step 2, total income minus 7 lakhs. How much is total income? 7 lakh 25,000. Na? 7 lakh 25,000 minus 7 lakhs. How much? 25,000. Step 3, we will compare step 1 and step 2. Step 1 is 22,500. Step 2 is 25,000. As step 1 is less than step 2, rebate available is equal to 0. So tax will be 22,500. To this we will add HEC at the rate of 4%. How much? 900. How much is final tax liability? 23,000. No, rebate is not available. See, if total income is up to 7 lakh rupees, then rebate is tax or 25,000, whichever is lower. Here total income is more than 7 lakhs. Na? So rebate is to be calculated in 3 steps. Tax on total income. In booster material also I have given this calculation. I gave these steps. Next. So answer is 23,400. Let us check. 4 answer is C. Now shall we see questions, everybody? Mr. Amit, having business of manufacturing of furniture, gives following trading and P&L account for the year ended 31st March 2025. Opening stock, purchases, freight and cartridge, sales, closing stock, gross profit, bonus to staff, rent of premises, advertisement, bad debts, interest on loan, depreciation, goods and service tax. See, depreciation as per accounts, this is not allowed. That is to be disallowed. Miscellaneous expenses. Income tax refund. This is not to be credited to P&L account, but it is credited to P&L account. What we need to do? We need to disallow it. Warehousing charges. We will see what warehousing charges are. Income tax refund includes amount of 4570 as interest allowed thereon. See, this is income on income tax refund, interest on income tax refund, that is taxable under IFOS. Salary includes 30,000 paid to his brother, which is unreasonable to the extent of 5,000. See, this is excess salary paid, that is not allowed as deduction. Excess salary will be disallowed. Next, advertisement expenses include an amount of 2,500 paid for advertisement published in the souvenir issued by a political party. The payment is made by way of account pay check. See, if any advertisement is given in political party calendar or journal, that advertisement expenditure is not a business expenditure, that is not allowed as deduction. Are you able to understand? Miscellaneous expenses include an amount of 1 lakh paid to political party, donation given to political party eligible for deduction under section 80 GGC because he is individual. It is also not business expenditure. While calculating PGBP income, we will disallow it. Okay. GST demand paid includes an amount of 5,300 charged as penalty for delayed filing of returns. The penalty is not allowed as deduction. Penalty is also to be disallowed. And 12,750 towards interest for delay in deposit. So whatever 12,750 is there now, it is for interest. Interest is also penalty, but that penalty is in the nature of compensation. So that will be allowed as deduction. Mr. Amit had purchased a warehouse building of 20 lakhs in the rural area for the purpose of storage of agricultural produce. The warehousing facility for storage of agricultural produce, it is specified business eligible for deduction under section 35 AD. This was made available for use from 15th July 2024 and income from this activity. So whatever warehousing charges is there now, this is income of specified business. Depreciation under Income Tax Act 65,000, that is allowed as deduction. Next, interest on loan includes an amount of 80,000 paid to Mohit resident, TDS not deducted. Whenever payment is made to resident and TDS is not deducted, 30% will be disallowed. So 80,000 into 30%, how much? 24,000 is to be disallowed. Compute total income and tax liability of Amit in most beneficial manner. See, he said most beneficial manner. We need to calculate tax under default tax rates. We also need to calculate tax under optional tax rates. Under default tax rates, section 35 AD deduction is not available. As section 35 AD deduction is not available, whatever the building is there, on building we will claim depreciation under section 32. Another important thing, under default tax regime, alternate minimum tax provisions are not applicable. When you are calculating under optional tax rates, deduction under section 35 AD is available, but AMT applies, alternate minimum tax applies. So what we will do, we will calculate tax liability under default tax regime. We will also calculate tax liability under optional tax regime. Out of these two, wherever tax is lower, we will pay the tax to the government. Are you able to understand? So in this question also, you need to calculate tax liability under default tax rates. You also need to calculate tax liability under optional tax rates. Wherever tax amount is low, that will be paid to the government. So all adjustments are explained. You can go through the solution. Next, question number 2. Mr. Akash, an Indian citizen aged 45 years, worked in XYZ Limited in Delhi. He got a job offer from ABC Inc., California on 1st June 2023. He left India for the first time on 31st July 2023 and joined ABC Inc. on 8th August 2023. So, all this is relating to 23-24. During 24-25, Akash visited India from 25th May 2024 to 22nd September 2024. He has received following incomes. The Indian citizen staying outside India comes to India on a temporary purpose. He will get covered under second exception to basic condition 2. Okay. For him, what will we check? We will check total income minus income from foreign sources. If total income minus income from foreign sources, if it is greater than 15 lakhs, if it is less than or equal to 15 lakhs. If it is less than or equal to 15 lakhs, only B1 is applicable, B2 is not applicable. If it is greater than 15 lakhs, B1 is applicable, B2 is not applicable, but in place of B2, modified B2 is applicable. Are you able to understand? So, shall we calculate total income minus income from foreign sources? Yes. Salary from ABC Inc. California received in California. See, this total is received in California, also accrued in California. So, we can call it as income from foreign sources. Dividend from Indian companies. This is Indian income. It is not income from foreign sources. Agricultural income from land situated in Nepal, received in Nepal. Foreign agricultural income, it is taxable under income from other sources. Next, rent received or receivable from house property in Delhi, 5,50,000. Careful, it is not income from house property, rent received. So, this is gross annual value. Gross annual value is 5,50,000, and from this we will claim 30% standard deduction. How much? 1,65,000. So how much is income from house property? 3,85,000. Profit from profession in California, which was set up in India, received there 6 lakh rupees. Now, out of this, salary in California is income from foreign sources. Agricultural income is also income from foreign sources because it is purely accrued outside India, totally received outside India. So these two we can call as income from foreign sources. How much is total income? 7 lakh, 5 lakh, 4 lakh, 3 lakh 85,000, 6 lakhs. Tell me. 7 lakh plus 5 lakh plus 4 lakh plus 3 lakh 85,000 plus 6 lakhs, 25 lakh 85,000. So total income is 25 lakh 85,000. Income from foreign sources. How much are income from foreign sources? 7 lakh plus 4 lakh. 11 lakh is income from foreign source. So how much is total income minus income from foreign sources? 14 lakh 85. It is less than 15 lakhs na. Only B1 is applicable. Shall we check B1? When he came to India, 25th May. When he left India, 22nd September. So, in May, how many days he stayed in India? 25, 26, 27, 28, 29, 30, 31. 7 days in May. June 30, July 31, August 31, September 22. 121 days he stayed in India, which is less than 182 days. B1 not satisfied. B2 is not applicable. So, residential status will be non-resident. As he is non-resident, only Indian incomes are taxable. Foreign incomes are not taxable. What are Indian incomes? Dividend is Indian income. So, it is taxable. Next, income from house property is Indian income. So, it is also taxable. So, total how much is taxable? 5 lakh plus 3 lakh 85,000. 8 lakh 85,000 is taxable. Let us see the answer also. Eight lakh 85,000. Did you understand, everybody? See, this much big question I say asked only for 6. examine and compute liability for TDS, if any, in the cases stated here under for financial year ended 31st March 2025. State Bank of India pays 70,000 per month and 60,000 per month as rent to central government and Mr. Kunal. See, rent paid to central government, on that rent 194I TDS is not applicable. Okay, next. Whatever rent paid to Kunal is there, on that rent TDS is required to be deducted under section 194I. Are you able to understand? Payment of 2,50,000 to Mr. Deepak, a transporter who owns 8 goods carriages throughout the previous year. He does not furnish his PAN. See, here transporter did not give PAN. Generally, if any payment is made to goods transport operator who owns less than 10 vehicles at any time during the previous year and furnishes PAN, TDS is not required to be deducted. However, here he did not give PAN number. As PAN number is not given, higher rate of TDS, twice the TDS rate, 2 into 1% or 20%, whichever is higher. That means 20% TDS will be deducted. Are you able to understand? You can see 20% TDS will be. And here payment made to central government, exemption. However, payment made to Kunal, TDS is required to be deducted under section 194I at the rate of 10%. Yes ma, Sinduri, less than 10 vehicles. Even though less than 10 vehicles, transporter should give PAN number. But transporter did not give PAN number. As transporter did not give PAN number, here TDS provisions are, here TDS will be deducted and at higher rate of 20%. Go and check section 194C. There I have mentioned less than 10 vehicles and PAN number should be given. But in the given question, PAN number was not given. As PAN number was not given, TDS will be deducted at higher rate of 20%. Question number 3. This is what ICAI will test this type of points only, where student will fall into the trap of ICAI. Student will think less than 10 vehicles, no TDS is required to be deducted, but actually TDS is required to be. Mr. Sahil, resident individual, aged 40 years, is an assistant manager of Fox Limited. He is getting a salary of 55,000 per month. So, 55,000 per month means annual salary 55,000 into 12 months. It will be 6,60,000. Dearness allowance 10% of basic pay, which forms part of retirement benefits. That means here DA forms part of retirement benefits 10%. 6,60,000 into 10%, 66. Bonus 60,000, that is fully taxable. Medical allowance is also fully taxable. He was also reimbursed medical bill of his mother dependent on him amounting to 6,500. See, medical bill of mother reimbursed by employer. Treatment is given in private hospital na, unless specified. So that benefit is taxable to employee. This 6,500 is taxable to employee. Mr. Sahil was provided a laptop both for office and personal use. Laptop was acquired by company on 1st June 2022. See, if any laptop is given, whether it is for office use or personal use, that is not taxable. That benefit is not taxable. Next, domestic servant at a monthly salary of 8,000, which was reimbursed by employer. Domestic servant facility, that is taxable to employee. Fox Limited allotted 700 equity shares in the month of October 2024 at rupees 170 per share against fair market value of 280 per share. So how much is fair market value? 280. From this we will reduce how much is purchase price? 170. How much is benefit received? Benefit received is 280 minus 170, 110 into number of shares 700. 77,000. That is also taxable to employee. Profession tax of 2,200, out of which 1,400 was paid by employer. Compute income from salaries. If he is paying taxes under default tax regime, see, if he is paying taxes under default tax regime, profession tax is not allowed as deduction. Not allowed as deduction. Okay. So all adjustments are explained. You can go through the answer. You will easily understand. Mr. Kushal is a resident but not ordinarily resident in India. During assessment year 25-26, he furnishes following information regarding his income or expenditure pertaining to his house properties for previous year 24-25. He owns two houses. One in New York, another one is in Ahmedabad. The house in New York is let out there at a rent of $5,000 per month. Entire rent is received in India. He paid property tax of $1,250, sewerage tax $750. See, whatever the income from foreign house property is there, that is also taxable in India. You can claim deductions normally. Okay. So how much is rent here? 5,000 per month. So gross annual value is equal to $5,000 into 12 months. How much? $60,000. He paid property tax $1,250, sewerage tax $750. So how much are municipal taxes? $2,000. How much is net annual value? $58,000. From this we will claim deduction at the rate of 30%. How much it will be? 17,000. Balance 40,600. Now can we convert it into Indian rupees? Income from foreign house property is equal 32,88,000. So that is income from foreign house property. 32,88,000. You understand? Sir, if rent is paid to owner who is non-resident, then TDS is required to be deducted. But if owner is renting house property in foreign, then also uh, should tenant deduct TDS? No, only if house property is in India. Simple logic. Non-resident is paying rent to another non-resident. How can he come to know that it is taxable in India and TDS is required to be deducted? TDS is required to be deducted only if payer is resident under section 194I. If non-resident pays rent to another non-resident, then payer is not resident, payer is uh, non-resident. So, no TDS is required to be deducted. The house in Ahmedabad is self-occupied. He had taken loan of 30 lakhs to construct the house on 1st September 2019. Construction completed on 31st May 2021. When loan was taken? 1st September 2021. Correct? Sorry. 1st September 2019. When construction completed? 31st May 2021. Construction completed 31st May 2020. So, before 31st May 2021, what is 31st March? 31st March is 31st March 2021. This period will be considered as pre-construction period. Now, shall we calculate interest for pre-construction period? For 1920, interest is equal to 30 lakhs into 10% into September to March. First September, September, October, November, December, Jan, Feb, March, 7 months. 7 by 12, how much? 30 lakh into 10% into 7 by 12, 1,75,000. For 2021, 30 lakh into 10%, 3 lakhs. The total pre-construction period interest is equal to 4,75,000. Whether total pre-construction period interest is allowed as deduction? No. Only 1/5 of pre-construction period interest will be allowed as deduction. 4,75,000 into 1 by 5. Much? 1,75,000. Sorry. 95,000. So pre-construction period interest 95,000. Current year interest 3 lakhs. 30 lakh into 10%, 3 lakhs. So total interest is equal to 3,95,000. But in case of self-occupied property, maximum interest allowed as deduction is only 2 lakhs now. So we will consider only you can see 2 lakhs. How much is pre-construction period interest? 3,95,000, but it is restricted to. Next, shall we see question number 4? Am I audible? Mr. Vishal, aged 33 years, submits following information. Mr. Vishal had a house in Delhi. During 23-24, he had transferred the said house to Miss Deepika, daughter of his brother, without any consideration. House would go back to Vishal after lifetime of Deepika. Actually, it is irrevocable during lifetime of transferee. Even though it is irrevocable during lifetime of transferee, the transfer was made with a condition that 10% of rental income from such house shall be paid to Mrs. Vishal. Rent received by Miss Deepika during 24-25 from such house property is 5,50,000. So what do you mean by this? Generally, if it is not revocable during lifetime of transferee, clubbing provisions will not get attracted. Even though it is not revocable, some benefit is received. 10% of benefit is received. So if there is any direct or indirect benefit, entire clubbing provisions will get attracted. How much will be clubbed? Here rent received. Rent received is 5,50,000. From this, we will claim standard deduction at the rate of 30%. 5,50,000 into 30%, 1,65,000. 3,85,000 is income from house property that will be clubbed. Mr. Vishal holds preference shares in Merces A Private Limited. He instructed the company to pay dividend to Miss Chandani, daughter of his servant. The transfer is irrevocable for lifetime of Chandani. Dividend receivable by Miss Chandani. See, this is the case of transfer of income without transfer of asset. Here also clubbing provisions will get attracted. Here he is not transferring asset. He is transferring only income on asset. Now, just because only income on asset is transferred, clubbing provisions will not get attracted. Sorry, clubbing provisions will get attracted. Section 60, transfer of income without transfer of asset. Here asset is not transferred, income is only transferred. So clubbing provisions will get attracted. Mr. Vishal has a short-term capital loss of 16,000 and long-term capital gain 15,000. See, short-term capital loss 16,000. Long-term capital gain 15,000. Short-term capital loss can be set off against long-term capital gain. Okay. Interest from savings bank account 1,75,000. This is eligible for deduction under section 80 TTA and it is taxable under IFOS. Cash gift 75,000 received from daughter of his sister. The sister is relative. Sister's daughter is not a relative. So whatever cash gift received is there, that is taxable. Income from betting, this is also taxable under IFOS and it is taxable at 30%. Income from card games, same 30%. Loss on maintenance of racehorses, this can be carried forwarded for 4 assessment years. So all adjustments are explained. You can go through the calculation. Next, enumerate cases where return of loss has to be filed on or before due date for carry forward of losses. Business losses, capital losses, losses from owning and maintaining racehorses. These 3 losses, if you want to carry forward to subsequent years, mandatorily you need to file ITR. Then only you can carry forward those losses. Otherwise, you cannot carry forward those losses. Are you able to understand? House property loss, unabsorbed depreciation, unabsorbed capital expenditure on family planning. These can be carried forward even though no return is filed. Are you able to understand? You are required to identify transactions in respect of which quoting of PAN is mandatory. The sale of scooter. See, in case of two-wheeler, PAN is not required. PAN not required. Payment of life insurance premium. Here life insurance premium is more than 50,000. So PAN is required to be quoted. Purchase of plot 9 lakh rupees while stamp duty value of the same is 11 lakh rupees. See, stamp duty value is 11 lakh rupees which is more than 10 lakhs. So PAN is required to be applied to PNB for issue of credit card. Here also PAN is required to be. So that's it. I hope you enjoyed this session. Let's meet again tomorrow with regard to model test paper 2. Okay. Thank you very much. Bye. Thank you very much. You are there till the end. Thank you. Good night. Bye.